The Vanguard 2019 forecast, part 2. So let's dive right into this real quick, and we're going to go over, as you can see, 44 pages of wonderful stuff for you to look at and read and tattoo on your memory. Again, that doesn't mean you should change any of your own financial planning scenarios, but here we go. So we got a bunch of different contents here. We got global economics perspectives, global capital markets outlook, and then the appendix. So let's dive right in first and foremost. Vanguard's distinct approach to forecasting. And again, the Vanguard piece is my number one go-to thing for looking at the future. Let me check my time because I don't want to keep these too long, 9:25, because I want to make sure we don't bore you to death, or else you'll unsubscribe and never come back. Did I say subscribe? Subscribe down below. All right. So that's what I was saying. So the Vanguard stuff I love because it has a distinct, well, they're telling us it's distinct. So I guess they put that in my head for it to remind you that Vanguard is distinct. But anyway, they always do this every year. And it's just fantastic because they give you what they're thinking about the future in easy to understand chunks. And you don't have to be a PhD or just you get it. It makes sense. That doesn't mean it's going to be right. Doesn't mean it's wrong. But I love the Vanguard stuff, and you should too. All right. So Vanguard's distinct approach to forecasting. To treat the future with the deference it deserves, Vanguard has long believed that market forecasts are best viewed in probabilistic framework. This annual publication's primary objectives are to describe the projected long-term return distributions that contribute to strategic asset allocation decisions and to present the rationale for the ranges and probabilities of potential outcomes. This analysis discusses our global outlook from that perspective of a U.S. investor with a dollar-denominated portfolio. Just real quick, you ever heard of Nate Silver? And I get whatever. The reason we're doing probabilities as opposed to very black and white is because that way Nate Silver can say, look, I gave Trump a 10% chance of winning the election, which meant that 9% of the chance I said he wouldn't, but I still had a Trump victory in my probabilities. See where I'm going with that? It's like, hey, we think the markets can go 100% up, but we also think it could go 100% down. We're giving a 10% to it going 100% down, but a 90% going all the way up. And if it doesn't go all the way up, we said, well, we did say it could happen. That's the one thing about that that kind of sticks with me. It's like, I get what they're saying, but at the end of the day, if you just use the probabilities, the probability is 33, 33, 33. Are you saying anything? And the answer is no, you're not. You're being, what's the word? Squeamish on your own predictions. But Vanguard doesn't do. They actually get a little bit more explicit, which I like. As the global economic expansion enters its 10th year, concerns are growing that recession be imminent. We expect the global economy to continue to grow, albeit at a slightly slower pace over the next 2 years. In 2019, economic growth should drop back towards a more sustainable 2% as the benefits of the expansionary fiscal and monetary policy abates. Europe and Japan are at an earlier stage of the business cycle, though we expect growth there to remain modest. In emerging markets, China's growth will remain near 6%, with increasing policy stimulus applied to help maintain that trajectory. Increasing policy stimulus. Increasing policy stimulus. Where have we heard that before? And that's the problem. Actually, Vanguard will dive into why that's a problem in the future, and I'll in this report, which I'll share with you here later on. Unresolved U.S.-China trade tensions remain one of the largest risk factors to our view. In addition to a stronger than expected tightening by the Fed, should their U.S. employment approach 3%. Man, in the old days, back when I was coming up in the early 90s, the full employment was 5% before you got not hyperinflation, but significant inflation. It's just weird how the Phillips curve, which Vanguard also discusses here, and I'll discuss later, has just been completely blown up, but yet somehow we still use the Phillips curve. Boggles mind. Previous Vanguard outlooks anticipated the secular forces of globalization and technological disruption would make achieving 2% inflation in the U.S., Europe, Japan, and elsewhere more difficult. In 2018, we rightly anticipated a cyclical firming in core inflation across various economies. In 2019, we do not see a material risk of further strong rises in core inflation, despite lower unemployment rates and higher wages, as inflation expectations remain well anchored. In the U.S., we expect core inflation to remain near or below 2%. An escalation in tariffs would only temporarily affect U.S. core inflation. In U.S. and Japan, price pressures will increase gradually as labor market slack erodes, though core inflation is likely to stay well below 2%. Higher wages are likely, yes, but higher inflation is not. Monetary policy, all right. Convergence commences with the Fed stopping near 3%. As inflation moves towards target, financial stability risks rise. Wow. And unemployment rates approach full employment. Again, what is unemployment? Full employment now? 3%, 3.5%, 4%. Again, it used to be 5%. Who said unemployment at full employment is 3%? When it used to be 5%, and now we look at 5% as horrible horrible unemployment. Who said real inflation is at 2%? Whereas before, 4% inflation was considered a win. I mean, see what I'm saying? It's like full unemployment at 5% would be considered remarkable, and inflation at that point would be very, very irksome to the Federal Reserve. Now we're looking at full unemployment at 3%. With inflation, we're hoping to get at 2%. You see how things change? That's over the course of just not my lifetime so much, but my academic studies. And I'm only 48 years old. In the U.S., we still expect the Fed to reach terminal rate for the cycle in the summer of 2019, bringing the policy rate to 2.75% and 3% before halting. We expect the first rate increase from the ECB, European Central Bank, in late 2019, followed by a very gradual hiking path thereafter. And we will see. I wouldn't bank on that at all. Japan is late to the party, and we do not expect any rate increases in 2019. I would not be surprised by that. Emerging market countries don't control their own destiny and will be proactively forced to tighten along with the Fed, while modest currency depreciation. Currency depreciation. What does that mean? That means inflation. Interesting, because a currency depreciation is synonymous, one for one, with inflating the money supply. Tempered by tightening capital controls is the most likely outcome in China. So they're saying in terms of quantitative easing, if you will. And we go here, remember that we just said China is going to have currency depreciation. And they talked about China. Where would they talk about before? They talked about expansionary fiscal monetary policy in China. So they talked about benefits of expansionary fiscal monetary policy in China, which will be a currency depreciation. If that doesn't make you somewhat suspect about the Chinese economy, well, you should be, because we've seen currency depreciation as a way for short-term stimulus time and time again. It'll give you a quick boost, but it never lasts long. And Vanguard talks about that a little bit differently than I will, but I'll share with you what they say. Time check. All right. With strong growth, disparate. Oh, we already talked about that. Okay. Oh, right here. So this is important. U.S. fixed income returns are most likely to be in the 2.5% to 4.5% range, driven by rising policy rates and higher yields across the maturity curve as policy normalizes. This results in a modestly higher outlook compared with last year's outlook of 1.5% to 3.5%. Albeit still more muted than the historical precedent of 4.7. Look, I take huge issue with this. Last year, they're reporting 1.5% to 3.5% on fixed income return. These are real numbers at net of inflation, 1.5% to 3.5%. Now they're saying 2.5% to 4.5%. And they're saying that's modestly higher outlook. That's a huge that's huge. We're talking a 1% increase to 2.5 from 1.5% before. So we take our trusty calculator and we divide 1 by 1.5. That's a 66.6% increase in a year in terms of your outlook of fixed income rates of return. And they say it's modest. That's not modest. Yes, it's not anywhere near the historical precedent of 4.7. That's a huge jump, my friends, in rates of return on fixed income. I don't understand why they say it's modest. That's huge. All right, so returns in global equity markets are likely to be about 4.5 to 6 for U.S. dollar-based investors. This remains significantly lower than the experience of the previous decades and of the post-crisis years, when global equities have risen 12.6% a year since the trough of the market downturn. So as of March 9, 2009 till essentially the end of 2018, global equities have risen 12.6% annually. So for those who got out You miss 12.6% annually. And if we take our trusted rule of 72, divided by 12.6, that means we doubled our money every 5.7 years. All right, so $100,000 invested in, at the end of 2009 is worth almost $400,000 today. We do not see, however, improving return prospects in non-U.S. developed countries. Non-U.S. developed. Okay, so non-U.S. developed. Okay, so they're saying they don't see improving return prospects, essentially Japan and Europe. That's what they're saying. Building on slightly more attractive valuations. We do, however. Okay, that doesn't make sense. We do, however, see improving return prospects in basically Japan and Europe, building on slightly more attractive valuations, a key driver of the equity risk premiums combined with higher expected risk-free rates. So they're saying at the end of the day, because the ECB, the European Central Bank, and eventually Japan will start raising their interest rates, the risk-free rates essentially on their government bonds, and their lower valuations for equities in those places, they forecast a higher and improving return prospects in those countries relative to the U.S. As was the case with last year, the risk of correction for equities and high beta assets is projected to be considerably higher than for high-quality fixed income portfolios. So that's critical. The risk of a correction for equities is considerably higher than for high-quality fixed income. So they have more opportunity for downside significantly for stocks. That's what they're saying. All right, let's pause here for just a second. We're going to go down to the next page here. Bear with me just a second. All right, so here they're looking at the economic cycles. Where are the countries in their economic cycles? And you see Brazil. Now, Brazil just elected the tropical Trump, and so that's interesting there. I don't know what that means relative to Vanguard's forecast, but policy does dictate expansion and recession, that's for sure. I mean, as I said in a video yesterday, at the end of the day, technology advances forward, and policy can either accelerate that to some degree or arrest it to some degree. It can't stop it. And so the tropical Trump, with Brazil being the early stage of expansion, but the problem is that you just don't know. I mean, what's her name? Rousseff, if she comes back, and who's that guy? Lula. I mean, these are outright Marxists. If they come back, who knows? So I don't know. I don't know what to make of the Brazil being in the early stage. The Euro area is in middle stage, they're saying. Japan's in middle stage, UK, India. Late stage expansion is the US, and then the ending stage of expansion, you see South Africa's. I mean, that's, they're just doing racist, taking farms from white farmers in racist endeavors, and there's only going to get worse. And I can easily see a lot of the productive parts of South Africa fleeing, just like happened in Zimbabwe, which is sad actually, because Mandela was a hero of mine. No other way around that. And it's sad to see the ANC being taken over, and it's not taken over by Marxists, but they have to appease some of those people on the far, far, far left. They did kick some of those guys out. I forgot the name of Mamula, or I forgot the dude's name. I can't remember. But anyway, he's bad news. And apparently he's developing more and more power to take on the ANC, which is the moderating force. And the days of Mandela are behind us, it looks like, in South Africa, which is sad. Russia, of course, that's a basket case economically. Mexico. It will be interesting to see what AMLO does in Mexico, or AMLO, AMLO, or ALOMO. I can't remember. But anyway, I'm keen on that guy to some degree. He's a Marxist. He comes from that area, but I'm not sure he is. He might be more of a pragmatist. And sometimes you need a pragmatist guy or lady from the old left to allow the media to get off your back and allow for economic just stuff that needs to be done, change. But here's my issue. Late stage U.S. expansion. All right. Now, Vanguard, I think they even say it down here. Where do they say about the U.S. is now? They're saying U.S. is in a late stage expansion because we are in basically the 10th year of our expansion. Our analysis of fundamentals and the historical drivers of recession lead us to conclude that continued expansion, albeit at a slower pace rather than an imminent collapse, is the most likely scenario for the global economy in 2019. This forecast is not sanguine, However, they expect the easing of global growth in the next 2 years, driven by fading boosts from U.S. fiscal stimulus, more restrictive Fed policy, and the continuing slow growth of China is fraught with economic markets and risk. They say about 10 straight years of U.S. Growth, and they say at some point it's got to stop. And that's in here someplace, but whatever. But here's my problem. The U.S. growth has been 2%, my friends, 2% for the last 10 years. That is not a significant growth. Yes, it's not recession. Don't get me wrong. It's not depression, heavens forbid. That is not fundamentally specific. I mean, laissez-faire capitalistic growth of the Reagan era or Calvin Coolidge. It's not. I mean, so to say that we're in the 10th year of an economic expansion and thus, we're this gray-beard economy, I'm like, well, it's been puddling along. I don't understand that. And so, late stage expansion, well, it's late stage only because, yes, it has been positive. We haven't had a recession, but it hasn't been much, for heaven's sake. We're not talking freaking, like I said, the 80s or the 20s. So at the end of the day, the economists, they say, well, this is what happened in the past. Thus, we can't expect more. Yes, you can. And you can expect more in Brazil. Maybe you can expect more in Germany, for heaven's sake. I don't know. But I do know is that when the shackles of regulation is put to the side of it, maybe even Italy, I don't know. But these growth that we've had are been limited. I just don't know why we have to assume that just because we've had growth that inherently means we're long in the tooth and must stop. Not when growth has been down here. All right, so let's take a break. I'll come back to part 3 of this, and I'll stop my diatribe on that. So don't forget to subscribe. Thanks, guys.